Yeah, all right. We'll give it a few seconds here as people trickle in. We have had quite the response to today's webinar, so we're excited to dive in. Excellent. Okay, I can see people in the room now. Hello and welcome to today's webinar here at Plan First Wealth. Today we will be covering 9 costly and common financial mistakes British expats make in the US. First of all, thank you all for attending. I'll be your host today. My name is James Boyle. Let's start with a quick disclaimer here. Plan First Wealth is a registered investment advisor. The information presented today is for educational purposes only. Plan First Wealth does not provide any tax and/or legal advice and strongly recommends that clients seek their own advice in these areas. One more note for everyone watching and listening at home. At the bottom of your screen, you'll see a Q&A button. Please feel free to send us a question anytime as we go through today's presentation. We do have a dedicated time at the end of the session to get to any questions that we miss. But if we happen to see some that come through and are relevant, we'll chat through them as well. So please don't be shy. We want this to be dynamic. I want to chat through what is top of mind for you. Okay. Without further ado, I'll now hand over to my colleague Richard, who will start with our agenda today.
Thanks, James. Okay, so we're going to give you a quick introduction to ourselves and why we think we have the authority to be talking to you on this topic. I'll then explain why I believe financial planning is different for British expatriates in America compared to non-expats. And then we will talk to you about the 9 common financial mistakes that we see Brits in the US making. Not the worst mistakes, but the most common ones we've seen over a decade working here, as well as talking about how maybe you can rectify them if you find yourselves in this situation, or ideally avoid them altogether. We'll wrap up by introducing you to our expat optimization system, which is universal to everyone, not just people working with us. And we will have a Q&A at the end. But as per James's point, I see some more people have come in here. As we go through this, please ask questions as they arise. Save you just having to listen to James and I talk for the next 45 minutes. We love the sound of our voices, but maybe you don't quite as much. So please throw your questions at us. If they're relevant, we'll ask them. We'll answer them as we go. And for any of them that we can't answer, we'll try and get to them at the very end.
Absolutely.
Still me. My name is Richard Taylor. I am the founder of Plan First Wealth. Hopefully, everyone can tell I am British. I have been here for 10 years and I'm now also an American. I live in Greenwich, Connecticut with my wife, children, and dog. And I set up Plan First Wealth because I believed, and I still believe, expats, and specifically for us British expats in the US, are woefully underserved. And this is always a problem, but I think it's a particular problem for expats because I think when we think about why we come here, we come to America for the opportunity. We come here for the career and financial opportunity. We bring our lives and our families. We were separated from our friends and family. We come here for the opportunity. Therefore, I think it is especially important that we capitalize on this opportunity. And that's why I set up Plan First Wealth to help fellow expats truly make the most of their opportunity.
Excellent. Thank you, Richard. My name is James Boyle. As I mentioned, I'm lead financial planner here at Plan First Wealth. My accent will give me away. I am American, going on 11 years in the industry, certified financial planner here in the States. But importantly, for today's topic, also dual certified in both the US and UK. So, fittingly enough, you have a Brit and an American on the call today. We like to say that together we help British expats simplify and optimize their financial lives. Excellent. So let's get stuck in. Why is financial planning different for British expats, Richard?
So why I believe it's different, or why I know it's different for expats, not just British expats, but for expats in general, is because we are subject, pretty much always, to some degree, subject to 2 different systems. We often have accounts, interests, assets, familial links, income streams in a different jurisdiction. And that just makes things more complicated. You then throw in the fact that these 2 systems don't always play well together, and there can be quite punitive consequences for getting things wrong. Now, this is mainly down to the US. I'm sure it comes as a surprise to no one on this call that the US can be quite distrustful and suspicious of non-US stuff, and therefore they make it challenging and sometimes outright impossible to efficiently own non-US stuff. And that's a lot of what we'll talk about today. So that's why I believe it's different. And then you factor in what I said before about the reason we're here. I believe it's different because it's I think it's even more important that we get it right because of the sacrifices we've made to come here. I'm not saying, yeah, I know there's a lot of good reasons why we come here, but there's a life we left behind, and I think that makes it even more imperative that we get this right.
Absolutely, Richard. I think, dare I say, that will become the theme of today's talk, right? This idea of two systems, two sets of rules, and the interaction between the two. Critically important to understand and navigate correctly. So let's get started with our common mistakes here, starting with mistake number one, assuming UK ISAs are still tax-free in the US.
So we led with this because this is one of, if not the most common mistake we see. And just give you a bit of background why we see this is when people are thinking of leaving the UK, rarely do they think they're coming forever or for 30 years. They think they're coming for a couple of years, they'll see how it goes, and then they might come back. And as a result, people don't want to give up their ISAs, which they might have spent 10, 15, 20 years building and have substantial assets in there. Why would you want to give that up? It's tax free, it's a great asset in the UK. So they hold on to them thinking this won't be a problem. When they don't realize that the ISAs are not recognized under the US UK tax treaty, which we'll talk about in a bit, and therefore they are not tax free in America. But it's worse than that. Usually they're invested in a non-US collective investment, which we'll also talk about in a second. And these are not well received in the US. In fact, they are punitively taxed. And second of all, because these are non-US assets, they are subject to additional US reporting, which people often miss, which means they then fall into non-compliance with the IRS, which can also have repercussions, penalties, statute of limitations issues. So you go from having this benign, very tax efficient, very tax friendly investment to suddenly it's taxable, it's punitively taxed, and it can have reporting and tax compliance issues. So it becomes a double whammy. So there are solutions. If you do find yourself in this situation, there are solutions. There are paths back into compliance. We see this all the time. It's not a bury your head in the sand situation. It doesn't go away. It doesn't get better. And even if you do want to maintain an ISA, there are ways to do it that don't mean you fall foul of all these problems.
Absolutely. We're going to keep coming back to this idea of tax complexity, right? And it can come across as vague a bit or ambiguous. So in the simplest term, this kind of tax complexity, if not approached correctly, creates penalties, right? Possibly fees, interest. Simplest terms, that means less money to you and more to the tax authorities, right? Which is obviously something we want to avoid. ICEs in particular, we wanted to kick off with these as well because it's such a perfect example, I think, Rich, of a, call it vanilla or innocent account back home in the UK that can create massive problems, headaches in the US and with no ill intent, right? That's something we see as well or hear sometimes is I didn't mean anything by it. I wasn't trying to pull one over on anyone, but unfortunately, the rules are such that that doesn't really matter, right? It creates problems and they need to be addressed or resolved.
This is something that's misunderstood here, James. If people think, oh, if I didn't know something, I didn't understand something, then I can fix it. There'll be no repercussions. And unfortunately, that's not how this works, especially in the US. They will penalize people, and it's compared to what we're used to in the UK, they're crazy high penalties for even innocent, what I class as innocent, non-willful non-compliance.
Yep. Yep. Exactly. Well, good segue to mistake number two here, which is holding UK mutual funds or ETFs, otherwise known as PFICs.
James,
Mhm.
hold on, we just got to go. Are SIPs included in ISAs? No, SIPs are separate to ISAs. SIPs are a pension. They are covered under the treaty.
Good
That was a
answer.
question if I wasn't clear. Sorry.
Yeah, you'll see it now in the Q&A bucket. Anyone watching the answered questions will go into that answer. But yes, Richard's right. The SIPs get treaty protection. Thankfully, ISAs unfortunately don't. PFICs, we just touched on this for anyone on the call who doesn't know what they are. Essentially, they are non-US, call them collective investments, right? So mutual funds, ETFs could be as something as innocent or vanilla as a tracker fund, right? An S&P or a FTSE. You might hold these in your ISAs, as we mentioned, maybe a general investment account, GIA, offshore bond, any other account you have back home. These are ultimately to be avoided or at least resolved. They are taxed harshly. That term punitive, I think, is a good fit here. Higher tax, they cause penalties, potentially fees, interest on those, and also create complex annual reporting requirements above and beyond what you would have, on a US account. There are solutions here, alternatives exist, but obviously on the call, if you don't know what a PFIC is, and many people don't, it's hard to know what to avoid, right? If you have that blind spot, it's very easy to walk into one of these landmines unwittingly, right? So takeaways here, you want to avoid them if at all possible. If you do have them and there are issues with them, then you do want to go be proactive and get them resolved.
You want to avoid PFIX at all costs, and they pop up everywhere. If you are holding assets in pound sterling or euros or any other currency, and they're not direct stocks, they're not individual stocks and shares, any collective, that's almost certainly going to be a PFIC. If they're in an ISA, they're in a GIA, general investment account, which we call a brokerage here, maybe an offshore bond, and plenty of other places, they will be PFICs, and they are generally trouble, and they want to be avoided at all costs. Um, James, we've got a few questions here, so we're going to rattle
Mm-hmm.
through them. Is there a risk that these investments get inadvertently included in a UK SIP? Yes, but because we're not tax advisors, so we want to check. You want to check this with a tax advisor, absolutely. But our understanding is because SIPs are covered under the tax treaty, they are recognised as a retirement account. Holding PFIX in them is generally regarded as being okay. You may still want to do the additional reporting. That's between you and your tax advisor. Some do, some don't. I had a conversation with one yesterday who does. Most of them don't, in my experience. But because they're in a SIP, you're not going to, and you're claiming treaty relief, which is something we'll talk about in a second, they shouldn't suffer these negative consequences. How many actions have actually been served for non-compliance? I don't think I understand that question. So maybe if you could add some additional. I don't really understand that. So maybe if you could add some additional to that question, we'll come back to it. Do pension AVCs from UK get covered by treaty pension provision? I believe so, yes. What's your remedy for being debanked by UK bank? Wise, perhaps. Wise. I've been asked what remedy for being debanked. You're living in the US for 3 years. My UK banks have decided to terminate my account. This is once they realize you're a US person, things can get very, very difficult very fast. For something called FATCA, people don't want to deal with the US people. There are some banks that will still open for US residents. Barclays being one, I believe. Although there's challenges with Barclays as well. We'll talk about that in a second. But you might want to try Wise.com or another FX broker to open these kind of like pseudo banks, which have sorting codes and GBP. Again, we might come back to this at the end, but there should be options for you. How are UK annuities treated? I think that I understand them to be a pension income stream, so they should be under the treaty. James, we better carry on, actually. We'll keep trying to answer these questions. Sorry, guys.
I mentioned that fantastic response we got to that webinar, which is great. We appreciate all the questions. It's going to mean that we're going to have to save some to the end here. Excellent. Okay. Mistake number 3, misunderstanding the US UK tax treaty.
So this actually touches on some of the questions we've just had. We are lucky that there is a long-standing and robust tax treaty in place between the UK and the US, and for the most part, that clears up any of these questions on who taxes what and when. So a point to note, though, it doesn't automatically mean that there is never any double taxation. Those of us who are in the US, or those of us who are US connected people for a long time, at some point will likely suffer some form of double taxation. Hopefully, it won't be significant, but it is likely to happen, especially if you end up going back to the UK. Of more importance, though, is the lack of awareness we see from people around the the act of actively claiming treaty treatment. And I'll give you an example to bring this to life. UK pension to SIP transfer, UK pension to SIP rollover. That is tax-free because of the tax treaty, because the tax treaty allows for it. But you have to actively claim that treatment. You have to actively, on your tax return, on a specific form, alert the IRS that you're taking this treaty relief, you're taking it as tax-free, and give a justification for it. You have to put them on notice. And if you don't, well, you can run into penalties, you can run into statute of limitations issues, and ultimately, the IRS can simply disregard that treatment, treat it as if you hadn't invoked treaty treatment, which you haven't, and tax it. Now I've given one example there, but there's loads that apply to pensions and other stuff. So it's this misunderstanding that it's an active process of claiming treaty relief can save you headaches and issues down the line.
This is such a common one, right? The tendency is to think of the treaty as this kind of blanket, safety blanket, right? I don't have to worry about it. It exists. It's going to protect me. But it is, as you mentioned, Richard, taking an active position that requires specific reporting. And as you mentioned, if not done in an audit, for example, which might relate to some of the questions we're getting, the IRS will treat it as if protection doesn't exist at all. So imagine not having that protection there when it could have, just because of misreporting.
Can we
Going to
answer?
jump to
No, let's go.
mistake
We'll come back.
number 4 here, ignoring currency risk. Or underestimating currency risk, right? So I'm sure a lot of you on the call today will have assets or income streams in GBP, right? In non-USD investments. The takeaway here is that ultimately you want to be in the currency you're retiring in, right? So if you're planning on staying in the States, ideally, most, if not all of your investments or income streams will be in USD. That mitigates currency risk. Obviously, not always possible in full, but there are ways to manage that, right? You are seeking to put together a currency aware portfolio to help introduce stability, mitigate that volatility from swings in currencies. 2025, frankly, is a perfect example of the kind of volatility you can see in currency. USD has dropped what 10, 11% on the year, 7 months in. So the questions become, number one, are you aware of that risk, right? Are you taking it into account? And then number two, are you taking steps to mitigate it where possible, and incorporate it into both your financial plan and income plan?
I'll bring this to life with an example. So when I first got here, I remember chatting to someone who had been quite senior at BP, and they had retired, and they had retired on a defined benefit final salary pension scheme, and it was over £100,000 a year, but around £100,000 a year. And 2007, 2008, that was worth about $200,000 to them, if anyone remembers back those heady days. And then after Brexit, that fell to down, ignoring inflation, fell down to about 124, $25,000 a year. That is an enormous fluctuation in income to manage. Now this guy was quite successful, but even so, that was hard for him to bear. Even just the idea of it, let alone the reality. And it's harder to do in a final salary pension, but there were still ways for him to have mitigated that risk. But just to highlight the point that you really want to be in the currency where you're going to retire as soon as possible, and FX can have an enormous impact. People are focused on things like um, stock market returns, and rightly so, and they often completely neglect currency risk, and it can trump them all.
Absolutely. Mistake number 5 here, another popular topic. I suspect we'll get some questions about overlooking US UK estate tax exposure.
Going back to my point earlier about there being two systems, this applies again. So that we are all subject to two systems. Now, the income and capital gains tax system is largely based on residence. It's a bit different for US, but it's largely based on residence. Whereas estate tax is much more based on domicile, which is altogether more permanent. Now, it's changed recently, but you can move to the US and still be subject to UK estate tax and inheritance tax, as we call it. And this is important because in the US, we don't really think about estate tax because the personal allowance is 15 million. In the UK, the allowance is £325,000. After that, your worldwide estate is subject to inheritance tax at 40%. So it can be an enormous chunk of your net worth is taken if you are still subject to UK inheritance tax. And even if you do manage to shed UK estate tax on your worldwide assets, any assets you have in the UK will still be subject to it, and people don't realize this. And second and thirdly, the two systems often sound the same. And I'll give you an example here. Trusts. Both the US and the UK use trusts, but these trusts do not always play well together. In fact, they rarely play well together. And a trust in one jurisdiction can trigger consequences in another. And furthermore, if anyone associate with a trust in one jurisdiction, the settlor, we call it a grantor in the US, a trustee or a beneficiary, moves to another jurisdiction, that can set off that can change the domicile of the trust, which can have tax consequences. That can lead to double taxation. That can be a real minefield. So we find people think about this a lot less than they should because it's down the line, it's in the future, it's not top of mind like income taxes, but it can have real consequences.
Comes down to protecting family, right, or heirs, beneficiaries, and we talk about proper structuring. That's going to be the solution. Unfortunately, as an expat, there will be an added layer of complexity, right? We'll keep coming back to that topic. This idea of proper structuring across two systems.
James, I'm just going to answer a question here.
Mm-hmm.
Are UK SIPs now part of UK inheritance tax? Yes, they are. This is part of the rules that have just changed. No one's quite sure how it's going to work out in reality because as things are currently written, it looks like the your heirs would get taxed twice, essentially. The SIP would get taxed would be included in inheritance tax, and then when your heirs took money out, they would get taxed at income tax rates as well. So it would be a double whammy, a huge hit. People seem to be of the opinion that this is essentially an accident and will change, but as we stand, that's where we're at. That's where we're at.
One of the good examples, I know we're leaning on the IRS here, right? Talking about a lot of the U.S. focused potential landmines. That is an active and current one that's in discussion. This idea of a UK pensioner SIP suffering inheritance tax and then income tax upon distribution. Definitely something to be aware of. Mistake number 6, missing Roth IRA opportunity. So we've spent a lot of time, obviously, covering mistakes, right? Landmines today, but it's also really easy to overlook certain opportunities available. So for anyone on the call who doesn't know what a Roth IRA is, essentially it's an account that offers tax-free growth and withdrawals. Very powerful account type. So you could be looking at an account with assets that grows for 10, 20, 30 plus years, completely tax-free on the growth. And then when you go to take money out, also tax-free incomes. We see a couple of different misunderstandings here. Sometimes expats assume they can't contribute or use these accounts either because of their income or status as expats, but strategies do exist. You might be familiar with the term Roth conversions. That's a strategy we look at and implement for our clients. They can create pretty significant long-term tax savings, right? All about reducing that lifetime tax bill if done right. And even more specifically, for expats, if you're on the call and considering potentially a move back to the UK, there's an opportunity for, to use a fancy term here, to use industry jargon, GR arbitrage, right? Tax arbitrage, taking advantage of lower tax rates in this vehicle in the US, moving back to the UK and being able to enjoy fully tax-free distributions.
Roths are a fantastic tool to reduce lifetime tax bills. They really are. Whether that's going back to the UK or we use them extensively in our pre-retirement and early retirement clients. They're a fantastic way to save significant tax dollars over your lifetime. But in my experience, this is just like a blind spot for expats, which is strange because in the UK, we all took advantage of our ISA allowances. Like we were red hot on, everyone was red hot on ISAs. But we come here and Roths are not the same, but akin to an ISA, and we don't take advantage of it to the same extent. And I put that down just to a lack of familiarity with the system, maybe. But they are a real opportunity to save real tax dollars, and I think it's a missed opportunity for a lot of expats, British and otherwise.
Yep, absolutely. Mistake number 7 here, relying on a UK only or US only financial advisor.
Or tax advisor or estate planning attorney. I'm returning here to my theme of two different separate systems. And we will encounter people who have moved here. They had a UK financial advisor and they maintain that UK financial advisor because they have a good relationship. The only problem is now that UK advisor doesn't know anything about America. And we've literally had this where we've taken on a client who's had a UK advisor for 20 years and have maintained, actively managed a portfolio of PFICs for 20 years. Everyone thinks they're doing a good job and they're just creating a hideous tax problem for this client. So that's something we encounter. More common is the person who moves here, becomes successful, great, hires a US financial advisor, great, but that US financial advisor knows nothing about the UK. or the interaction between the UK and the US. And I call it a tumbleweed moment. You'll be speaking to your advisor and you'll ask about your UK pension or your UK ISAs or whatever it might be. And it's tumbleweed because the advisor hasn't got a clue, doesn't know where to turn, and just wants it to go away. And what happens here is, at best, there's an opportunity cost. If you have hundreds of thousands of pounds in pensions and other stuff, well, at best, it's just neglected. At worst, you've got stuff in there that you shouldn't have and that could have been dealt with 10, 15, 20 years ago. Um, there's just blind spots. You need someone who understands the US, the UK, and the interaction between the two. Be that a financial advisor, be that a tax advisor, be that an estate planning attorney.
Blind spots is such a good term, right? Because we use this term landmines, right? And if you have blind spots, it's very easy, sometimes arguably inevitable, right, that you're going to trip up one of these arcane cross-border landmines, unfortunately, and have, you know, some issues that come up from it. Mistake number 8 here, mismanaging UK pensions and or property sales. Again, another very common area for us. So pensions, you alluded to this earlier, Richard, the opportunity cost, right? Very, very often the people we're speaking with have legacy UK pensions, employer pensions that have sat for 10, 15, 20 years, right? Not sure how they're being invested, not sure what kind of fees are being assessed on the accounts, not sure how they incorporate into the overall plan itself. So that is a true cost, right? Opportunity cost of, call it, neglecting those pensions. Also, upon distribution, if you're heading into retirement and expecting to start taking withdrawals, obviously the question of withdrawals from these accounts, they can be taxed very differently in the US. Treaty elections matter here critically, which we mentioned. PCLS, pension commencement lump sum, that's that 25% available to you in the UK tax-free. Not going to get into the weeds here. That could be a webinar in and of itself. But there are questions about how is that taxed in the US, both federally and on a state level, right? Depending on what state you're living in when you go to take that distribution. Also about the reporting, right? Making sure that you're reporting correctly. And if you're invoking a treaty position, specifying what that is and following the correct forms. Property sales. We touched on currency earlier here. Very often come over to the US, you might have a home in the UK, maybe you've rented it out. The discussion comes up. Should we think about, selling that property? Is it worth the rental? Is it worth the headache of managing overseas? Currency plays a big role here, right? And especially in the kind of bad scenario where you can actually realize a loss in GBP and then the IRS comes knocking for capital gains tax. So again, to say that again, you can realize a loss on a property and then owe capital gains just because of a shift in currency. Unfortunately, I know, Richard, you had a specific relationship that this happened to, unfortunately. Not only is that a bad line scenario, right? Headline, something you don't want to run into, but it's especially painful if it's blindsides you, right? If you hadn't anticipated that, if you hadn't worked that into the plan. And it comes back to this idea of cross-border approach, avoiding these tax traps and the unfortunate surprises that can sometimes arise from them.
Yeah, and this I've as James says, I've really experienced this. This is a client who bought this property when they were in the UK before they'd even considered moving to the US. They bought it in pounds, no connection to the dollar, but they sold it as a US person. And when they sold it, you have to convert everything back to dollars for your tax return. And the change in the currency had been so substantial that it looked like a dollar gain. And that really stung them. More recently, we're dealing with a client right now who's sold a property in the UK, has got a serious chunk of change and they deposited into their UK bank account. And the UK bank is making it almost impossible for them to transfer it out. They're requiring them to come into the branch. They are basically locking them out of their account every 10 minutes. They are they're now limiting how much they can transfer out each day. I think this probably could have been avoided with a bit of planning. Different bank may be the wise option I mentioned before, but yeah, it can be a bit of a minefield.
Absolutely. Landing on mistake number 9 here, failing to integrate UK and US financial planning.
So I feel like I'm flogging a dead horse here, so I won't belabor the point. But again, back to this idea of two systems. And if you are planning and you are neglecting a chunk of your assets or your interests, I don't know, 10%, 25%, 30% or more, you are you've got one arm tied behind your back. If you are not integrating your US and your UK affairs and assets, that we see this has a material impact on your retirement. Now, people realize this when it ends up costing them real money because they have to go through some compliance program because they stepped on a landmine. But what we see far more frequently and what people don't realize is the opportunity cost. People come to us in their 50s and older with often with UK pensions, and they've kind of reached a point where they need to deal with it because they're starting to think about retirement. And we look at it, and we could had we got involved 10 years ago, 15 years ago, there will be more money in that account now. It's a real cost. It's an unseen one. So failing to integrate your global balance sheet, your global assets, your global interests in a financial plan is to your detriment.
Richard, early conversations and ongoing conversations with people we speak with often come back to this idea of fears, right, or concerns. What is top of mind for me right now? When you're in that pre-retirement phase, very often a very common sentiment we hear is the question of, am I going to run out of money in retirement, right? Put simply, can my assets sustain my lifestyle in retirement? To your point, if you're overlooking a large chunk of that asset base, how can you answer that question? It is the integration, it is the coordination, we think, obviously, in our view, that can build a plan that helps deliver that clarity, control, and peace of mind as you head into retirement. So, how do we do that, Richard?
I think a lot about how people can make the most of their situation, how they can maximize their opportunity. Obviously, I'm thinking specifically from a cross-border expat perspective in the US. But this, what you're looking at, is universal. This applies to pretty much every single person, all of us, cross-border or non-cross-border. It applies to me, it applies to James. It's just when it's cross-border, I believe there's additional expertise, experience, knowledge, whatever you want to call it, required to make it work. But this is universal. Whether you work with advisors or whether you DIY or whether you go to someone on whatever you do, this applies to you, me, and everyone else. This is what we do. We are involved in a specific part of this, and we also put the whole thing together, which I'll talk about in a second. But you need to be making sure all these buckets are filled. So the financial bucket, which is what we get involved in directly, I believe everyone should have a financial plan that maps out into the future, tells them whether or not they're going to be okay, and helps them make informed decisions. Otherwise, how do you make decisions? It's finger in the air guesswork. We believe that everyone should have an investment management plan that serves the financial plan. And that as you get close to and into retirement, you need a separate and additional tax plan to minimize your tax obligations and an income plan to make sure you can turn your asset base into a sustainable income stream that outlives you. And finally, and just as importantly, you need to take advantage of all the financial opportunities available to you while avoiding all the financial landmines, expat and otherwise, year in, year out, for decades. At the same time, you need a tax plan. You need to be in tax compliance. Now, I am referring mainly to the IRS here because they're the ones with the idiosyncratic and multiple requirements and also the punitive penalties, but I do mean all tax authorities. And we want to make sure you're in compliance. You're not going to get a nasty surprise ever. You're never going to get something in the middle of retirement that you can't recover from. And then once we've done that, you need to make sure that you pay as little tax as legally possible. Pay every penny legally owed and no more. And to achieve that, you need your tax advisor, whether it's you or a professional, and your financial advisor, whether it's you or a professional, working in tandem, communicating, having a relationship, understanding effect. You need to do tax planning. And then the third part of this jigsaw is estate planning. You need to be compliant. And by that, I mean you need to make sure your estate plan doesn't inadvertently upset or create issues in another jurisdiction. And after that, you need to make sure it's effective. You need to make sure that in your lifetime, while you're alive, if something happens to you, your wishes are followed, your needs are met. And then after you're gone, that your family doesn't suffer administratively and or financially. I wholeheartedly believe that the way to achieve this is through having cross-border professionals in each bucket and to have them working together. I cannot stress that enough. They need to have a relationship. They need to meet specifically about you and do proactive planning. Otherwise, so many opportunities are missed. We do this. We do the financial part directly, and we manage the whole thing, either working with existing advisors or we can bring in our own advisors who are used to this, and we will pay some of the costs towards this. That's how serious we are about tax planning. But make no mistakes, this is universal. This applies to everyone on this call, whether you have advisors or not, whether you have a plan or not. Okay.
Excellent. Thanks, Richard. So I know we're going to get to the Q&A session in just a minute here. We have some questions coming in. Like I said, don't be shy. Send them through. But I know we also have covered a lot of ground today. So if you have more questions, if anything sounds like an issue that might apply to you, or if you have concerns on your own specific circumstances, we can have a chat. We're offering a free exploratory Zoom meeting, 30 minutes, no cost, no obligation. You get to know more about us. We get to know more about you. We can discuss your specifics and outline if and how we can help. This QR code here, all you have to do is take out your phone. That will bring up a link directly into our calendar. So like I say, find a convenient time, we can go ahead and have a chat. I'm going to leave this up for just a few seconds here. I'll bring it back up at the end. We're going to
Well,
get
James,
into.
Should we start with the Q&A? Should we start with David's message? Because that's been there for a while.
Yeah, sounds good.
Yeah. Okay, so someone's asked, is the DT US individual best way to ensure non-double tax? So just for a bit of clarity, I think what's been asked is in the UK, when we receive money from retirement accounts, it gets paid through PAYE. I'm sure everyone remembers getting paid through PAYE. And that means that a tax rate is applied. And it could be emergency tax or it could be lower, but essentially money paid through PAYE will suffer UK tax. Now, that's not actually double tax because under the treaty, if you're a US resident, the US gets to tax UK pension income. So you would then have to you'd have to pay income tax in the US and then claim that back from the UK. But that is an unpleasant process because you might end up paying 40% to the UK. I'm wild. I'm picking these numbers out of thin air, right? You might pay 40% to the UK, 40% to the US, and then have to claim it back from the UK. So that can be a cash crunch. It's not double taxation, but it's unpleasant. The way to avoid that is to apply for a double taxation. Sorry, a NT. I think this is what this is referring to. An NT tax code, non-taxpayer code from the UK, and you do that by submitting this DTUS individual form. It goes to the IRS, it goes to HMRC. It takes about 6 months to a year for them to process. And then you can have a non-taxpayer, an NT tax code applied to your PAYE system in your SIP, and it will pay to you gross. It's a pain. It takes a long time. It's absolutely worth it. So it doesn't help you avoid double taxation because you're probably not at risk of double taxation, but it does save you trouble.
And it's a bit fickle, right? I know that
Yeah.
different custodians, different platforms in the UK treat them differently. So you want to make sure you have an understanding of how they're applied and what that process looks like. We also have had cases. I've had clients who have had to submit different forms for each pension. So keep in mind that it might be individually applied to different pensions worth doing the legwork there. As you say, Richard, if you're taking, you could be looking at multiple years of distributions. You get over that initial headache of filling out the forms and things. It's well worth having that applied.
That's a suit. Is there a US UK double taxation relief available for capital gains on the sale of UK property? I a UK is a UK property is a UK citus asset, and I think the UK will therefore tax it first, and then I think under the treaty, I don't, because it's been taxed in the UK, I think you get credit for that in the US. And then you might have to, if there's any further tax due in the US, you'd have to pay there. But I don't think you get, yeah, I don't think you can get double tax because of the treaty. But I think you'll get taxed first in the UK and then the US.
And no, to our understanding, correct me if I'm wrong, Richard, no primary residence exemption, right, for a UK property. Um,
Well, it depends on when you lived in it. how long ago you lived in it, if assuming you lived in it. You also there's also you can get into issues with depreciation
Mhm.
because the US forces you to depreciate property and the UK doesn't, and then the UK reclaims that depreciation upon sale, but there could be a mismatch in the tax. This is an issue we're working on right now. You've got to be kind of careful with property. You can end up getting double taxed because of this mismatch between depreciation. That's not the question that was asked there, but that's definitely something to be careful of. We found that that's making investing in non-US property extremely unattractive.
Just a quick one here. Do you have to apply for a UK NT tax code every year? Our understanding is that no, once it's applied and it's in the PAYE system, it will apply to pension payments. Couple things to keep in mind. Typically, we recommend 12 months in advance of anticipated withdrawal. So if you're going to need withdrawals within the next year, that might be a good time to go ahead and apply for the NT tax code. The reason we don't recommend it earlier is we've seen cases where if you apply for an NT tax code, it gets applied and then it sits dormant for a while. If there are no distributions or withdrawals, HMRC can actually revoke it essentially as inactive. And then you have to unfortunately go through the process again. So 12 months, rough recommended timeline.
Right.
And just another quick one on NT tax code, essentially asking, does HMRC let you know? We've had different experiences here. Generally, no. We have had clients contact HMRC directly, and they are able to confirm once the NT tax code is in place. So again, not an ideal solution, but you can check.
2 years is too long though. I've not had one take 2 years.
2 years is a long time. Yeah.
Yeah, I'd say a year is kind of average, but 2 years is a long time. James, I'm just going to address a couple of. So we're asked here
Mhm.
about foreign tax credits. I'm just going to go. I'm not. I don't have the experience to even attempt to answer this. Our clients tend not to have foreign tax credits because they came over here, let's say mid 30s, without fresh from the UK, so they had no foreign tax credits. So I know that is a strategy. I recently, if anyone listens to the podcast, I met with Buzzercott. I know Buzzercott make a lot of use of foreign tax credit planning. So I personally am not have no authority to answer that question. But it is a legit strategy if you have foreign tax credits. Um, right. Couple of questions. Is the IRS watching this? I don't know. I hope not, just because anything through the IRS makes me deeply uncomfortable. But I doubt it.
Could this be
I'm interested
this
why that
person
question
with
was
the
being
IRS?
asked. Yeah. And also, right, I've asked so that before we were asked a question about how many actions are served for non-compliance, and that person has expanded on this by saying how many actions are served by IRS against individuals for non-compliance. I don't have an answer to this. There is data on it, but I have a few things. I have a few thoughts. So first of all, if you get selected for audit, either as part of a campaign or just as part of their random quality sampling campaign, and this will be part of an audit, and they will penalise you for it. And if anything's to go by, they will not show mercy. They do something called penalty stacking. So for the same transgression, they will stack different penalties, and it gets ugly very very quickly. So if your strategy is just to play audit roulette, like, I mean, I can't honestly comprehend that mindset because you enter into retirement and if you're just unlucky on getting audited, and it could be life changing. So I don't know, but it's just not. It's just my experience. People don't want even if the risk is remote, it's just not a risk worth taking because the repercussions are so awful, frankly. But I will add to this, and I think this is going to get worse, and because, long story short, 2010, the US enacted some legislation called FATCA. FATCA basically does many things. One of the things it does is it requires non-US financial institutions to report back on their US clients. So for the last 15 years and going forwards, there is a mountain of data traveling to the IRS each year of US persons who hold non-US accounts. And it used to be the thought that, that information is overwhelming. The IRS are underfunded and, let's not worry about it too much. But with the advent of AI, personally, I think it's a matter of time until this information is just trawled, and it will just trawl this information. It will match this person here has these accounts. It's not doesn't match up with what's on the tax return, and then you're in trouble. You'll start getting letters asking you to explain this. And the problem is when this stuff isn't reported correctly, there's no statute limitations. If FBAR or no, not FBAR, FBAR is 6 years. If any of these 3520s, 18, 6, if any of these FBATCA bank account, foreign account reporting forms are missing, statute of limitations doesn't start ticking, so they can come after you at any point. So it's just not a risk worth taking, I don't think. But they have shown that when they do catch people, they don't show much mercy.
That was just I was going to highlight that, underline that is if you want to find examples of it, they're out there. We can talk about FBAR penalties and PFIC penalties that have come up, and I mean, again, we hope the IRS is not watching because these are really harsh, punitive penalties applied that can upend what would have been an otherwise successful retirement, right? So I know, Richard, you talked a lot about the people we work with heading into retirement. The goal very often, not always, but very often is to mitigate those risks where possible. And if you are embarking on a 10, 20, 30-year retirement with the threat of audit, some of these issues coming to light, it's just not worth the risk in our view.
Hey, Phil. Yes, Phil, we can recommend people, and our list has actually expanded. So there's obviously the people you hear on the podcast, which anyone listening is called We're the Brits in America. And we actually have more people now, and we can tailor an introduction to your needs. So uh, Phil mentioned the podcast recently. We had Holly from Buzzercott. Buzzercott are a top UK, US, London-based firm. Right? They deal with and you'll hear from on the podcast that each person is assigned 3 people on the team. So there's always someone on hand to answer your question. They are all UK, US. The department is 80 deep. And they're a top firm, but they're really expensive. Now, sometimes we meet people who need this. They have business interests in the UK, which makes things exponentially more complicated. Sometimes that's what you need, but oftentimes it isn't. And we have tiers. We have other people in the UK who have similar experience, similar expertise and experience, but cost a little bit less. And then we also have some people in the US now who are cross-border, but maybe not as UK specific. And each comes with a different price point, and we can help people find the right professional for their needs. And then for our clients, we also pay for some tax planning separately for our clients. That's a whole different thing to talk about. And yeah, same for estate planning. We have a couple of good estate planning attorneys who we can. Estate planning is harder though because it's state by state, so that just adds to the complexity.
There's a good question here that touches on something that I think it's worth pointing out because we usually get questions on this. Essentially asking what other changes beyond WEP elimination are likely to affect this group. So just in case anyone listening isn't familiar, there was a provision, windfall elimination provision, as part of Social Security that was eliminated in December 2024. That was previously a reduction in your Social Security benefit because you were eligible for a foreign state pension, in this case, UK state pension. So that's gone now, which is great news. That's a win. Nothing comes to mind, Richard. I'm interested to hear if there have been any recent changes, but just highlight that the nature, that's a good question, number one, because the nature of these things is that things change rapidly. And the outlook can look different year on year. We have a very specific example that I know I can point to. I don't want to get into the weeds on it, but it is inherent, intrinsic to being a cross-border person that the interpretation of treaties, the treatment of these different products, account types can change, and you need to be adaptable and have a dynamic plan. I think that's one of the takeaways I would mention there.
Well, the UK rules have changed. Not, I mean, I assume they meant this administration in the US, but the UK rules around uh, inheritance tax and domicile have changed dramatic. An overhaul after only 250 years, and that's had quite substantial changes, mostly positive, I would say, for us
Hmm.
here in the
Hmm.
US, and anyone who's going back as well. So, if anyone's interested in that, check out the episodes with Aidan Grant, a UK attorney, on the podcast. But that's mostly good, frankly. And Web, obviously, huge win for expats here. That's
Yep,
great news.
absolutely.
Let me tackle this one. The 400,000 one. Right. So we have a
Hmm.
question here. If I inherit, say, £400,000 post IHT from a UK state, will there be issues transferring this to the US? I am now a US citizen and full-time resident. Great question. It's going to be a different answer to what you expect. In terms of bringing it to the US, no issues whatsoever. Shouldn't be. Your bank might make things difficult, but that's surmountable. But in terms of, like, some people will say, is it taxable if I bring it to the US? No. However, huge however, you have to report an inheritance or a gift from a non-US person on Form 3520 if that inheritance or that gift is over $100,000. And if you don't, they will apply penalties, and they will apply. So this question before about this is in the news right now because someone's won. This is in the news right now. The IRS are so hot on this, and the community's kind of up in arms because it's so unfair. The penalty for not reporting this, no tax is due, by the way, no tax, but the penalty for not reporting it is, I think it's 5% a month that this form is late, up to a maximum of 25%. So if you've missed it, people generally miss it by years, and they'll come after you for 25%. So if you're in, that's £100,000 in this example. You didn't underpay any tax. You just didn't file the Form 3520, report, notifying them that you received this inheritance, over $100,000, and the 25%, and they are all over this. It's frankly, I think it's immoral, but that's a different webinar, different topic.
Reporting. The only
And
other
this
thing
is
I'd
why,
add.
James,
Mhm.
sorry, this is why people sometimes say to us, oh, you know what, I've got nothing in the UK anymore. And you might not have anything in the UK. Maybe you've closed all your accounts, although that's unusual. Maybe you've spent down your UK pension, again, unusual. But let's just say you really, really have. People still have family in the UK, and at most
Mhm.
people will still generally receive an inheritance. And if you don't have a cross-border financial advisor, a cross-border tax attorney who's going to spot this, you're going to miss that 3520, and it may catch up with you one day.
Yep. The only other piece I would add to that is we tackled that question assuming it was cash, right? You might find that, going back to this PFIC problem, maybe you
Oh
inherit a
yeah.
bundle of mutual funds or ETFs in an investment account. So something to absolutely uh, be aware of. So we are wrapping up here. Anonymous, it's just like we practiced. You're asking for client referrals and things. We're going to jump to that. I'm going to share the meeting QR code again just to wrap up. We're going to plug our podcast, but we appreciate you asking for email addresses. And
Should we just address this last question came in? Because I
yep.
think this is a worthwhile one. So we've been asked, when would a treaty position claim be sent to the IRS post PCLS receipt? Immediately, or the applicable year tax return? So just for everyone listening, PCLS, UK pensions are entitled to 25% tax-free lump sum. Let's just call it lump sum. So if you have $1 million SIP, you can take $250,000 tax-free in the UK. Is that tax-free in the US? There are conflicting opinions. It's not settled. Most good tax advisors I know are comfortable to treat it as tax-free federally under the treaty, as long as a treaty position is invoked. And that requires, I think it's Form 8833. And to answer your question, David, that is sent in with that year's tax return. And you 8833, and you specify, you're taking a treaty exemption and under this article of the treaty. And the reason this is so important is, one, so you can claim that, the treaty, you have basis for your claim. But two, that starts the statute of limitations clock ticking. if you miss out that form, that statute of limitations clock might not start ticking, and they can come back to you in 5, 10, 15 years, whatever it might be. Whereas if you filed it and you filed everything else correctly, they should have 3 years. If they don't come back to you in 3 years, it doesn't matter whether it's settled or not. It's done, as I understand it. So that's why that kind of thing is so important. And moving on, unless you have anything to add to that, James.
No, no, no. That's a good point.
We've been asked, is it that 3520 for inheritance as well? Yes, it is. 3520 is it's a bogeyman of a form, honestly. It causes so much trouble, so much trouble. 3520 is a form for reporting an interest in a foreign trust, a non-US trust, and that includes most UK pensions, including SIPs. There is a form 3520A, and that is required to be submitted by the trustee of the trust. And if your trustee won't submit that trust, you have to do it. You have to file a substitute 3520A, and that is a beastly form. It's a beastly form. And if you don't file these, you have statute of limitations issues. You have significant penalty requirement exposure, something like 35% of anything transferred in, 10 grand a year on top of thereafter, minimum. And also on 3520, separate to this, is the line for reporting a foreign inheritance or gift from a non-US person over $100,000.
The only other piece I'd add, and you might have alluded to this earlier, it doesn't necessarily mean it's going to be taxable, right? The inheritance in the U.S.,
It's
but
not. It's not going to be taxable. If
yeah,
it's
it
cash,
does
it's
need to be
done.
reported. Yeah,
Yeah, and they will if they find out,
yeah,
they will come at you for that. That's what's currently being fought because it's just wrong.
yeah. Going to pull up the QR code again, just as we wrap up here. Someone asked for our email addresses as well. So again, QR code goes directly to our calendar. We also are available for questions by email. If you would like to reach out to us, it's just our names at planfirstwealth.com. So James at planfirstwealth.com, Richard at planfirstwealth.com. Shoot us a note. We're happy to have a chat. We've talked about the podcast a lot today. Just want to point to that. We're the Brits in America is the name of the podcast. All of our resources, though, we publish a wealth of content weekly. Our newsletter, all available on our website, www.planfirstwealth.com. We have a resources tab. You'll see podcasts, you'll see videos, you'll see blogs we put out, all designed, again, and catered to expats in America and all these issues that come up. Want to thank everyone again for attending. We will be having a webinar soon. More to come on that, so stay posted. Richard, any final comments when we wrap up here?
No, thanks everyone for attending. We'll be doing these semi-regularly. Again, feel free to suggest topics that are of interest. We think we have a handle on what affects people here, but we're also interested in what people want us to talk about. Likewise, if people have anything, suggestions for podcast guests, suggest away.
Absolutely. Absolutely. We want to hear from you. All right, everyone. Thanks for attending. Take care and talk soon. Bye bye.
Thank you. Bye bye.